Welcome to Islamic Finance for everyone.
Assalamu alaikum, dear viewers, and welcome back to Islamic Finance for Everyone. Today, we are diving into some crucial insights from the Islamic Financial Services Industry Stability Report 2025, hot off the press from the IFSB. This report is our industry's annual health check, giving us a clear picture of how Islamic finance performed in 2024 and what lies ahead for 2025.
The Islamic Financial Services Board, or IFSB, is the global standard setter, working to ensure the soundness and stability of the entire Islamic financial services industry, spanning banking, capital markets, and insurance. Their annual report is a must-read for anyone in this space.
And trust me, you'll want to hear this. This report reveals both incredible growth and some critical areas we need to address for the long-term resilience of our industry. So, if you are ready to unpack the state of the global Islamic finance, hit that subscribe button and let's get started. Let's kick things off with the headlines figures. The Islamic financial services industry entered 2025 with renewed growth momentum. In 2024, our global industry experienced truly robust growth with total assets soaring to an impressive $3.88 trillion.
This marks a significant 14.9% year-on-year growth compared to 2023, accelerating beyond average rates of recent years. This expansion was fueled by sustained demand, positive regulatory reforms, and increased market participation.
Geographically, the report confirms what many of us know. The Islamic financial services industry is still heavily concentrated. The GCC region dominated, holding over 53% of the global Islamic financial services industry assets. East Asia and the Pacific followed, driven by Malaysia and Indonesia.
However, there's exciting news from emerging markets, particularly in Africa and Central Asia, which posted the highest growth rates globally. This signals new frontiers for financial inclusion and deepening local Islamic markets.
But here's where we need to be realistic. Despite this impressive growth, the Islamic financial services industry faces a structural vulnerability. It's heavily dominated by Islamic banking, which accounts for a staggering 71.6% of total assets.
While non-bank segments like Sukuk and Takaful showed strong growth of 25.6% and 16.9% respectively, they still represent much smaller shares, only 23.3% for Sukuk outstanding and a mere 1.4% for Islamic insurance assets.
This structural concentration in banking creates imbalances. It limits the industry's scalability, the availability of the diverse Islamic investment instruments, and can heighten vulnerability to external shocks.
What do you think? Is this banking dominance a strength or a weakness for Islamic finance? Let me know in the comments below.
Let's zoom into Islamic banking. It continues to be the anchor of the Islamic financial services industry, showing strong balance sheet growth with a 17.05% year-on-year increase. This growth was supported by regulatory reforms and digitalization.
Financing growth was robust, not just in traditional sectors like household and real estate, but also gaining traction in emerging areas like renewable energy and digital infrastructure in select markets. Deposit growth also remained steady, reflecting strong customer confidence.
A key observation, however, is a shift in asset allocation in some jurisdictions towards safer instruments like government sukuk and cash. Why? It points to underlying constraints from the limited availability of a wider range of Islamic finance instruments alternatives. It's a sign of shallow market.
The report highlights a growing reliance on hybrid financial instruments, particularly commodity murābaḥah. These contracts account for a substantial and growing portion of both deposits and financing, especially in the EAP and GCC regions.
While Sharia-compliant in form, these murābaḥah structures often replicate the risk profile of conventional debt. These can introduce leverage, market volatility exposure, and systemic interconnectedness similar to traditional banking products. It's a crucial area for vigilance.
And, of course, fintech advancement is reshaping the industry. Valued at $138 billion in 2024 and projected to exceed $300 billion by 2027, it offers huge efficiency gains. But it also introduces new vulnerabilities. Digital platforms, crypto assets, and AI biases all require careful regulatory oversight.
Moving to the non-bank sectors, the Islamic insurance or Takaful sector showed a sustained growth, significantly outpacing the broader insurance industry. Total assets hit $54.4 billion by third quarter of 2024.
The GCC region dominates Islamic insurance contributions, but the ECA region experienced the highest growth rate, nearly 50%, driven by increased demand and regulatory reforms.
However, profitability and liquidity remain uneven, with some markets facing pressure from rising claims and limited access to Islamic reinsurance. More importantly, their ability to grow is also tied to the shallow Islamic capital markets, limiting investment opportunities. Now, let's talk about Islamic capital markets, primarily driven by Sukuk. This sector delivered strong performance in 2024, with new Sukuk issuance surging by 25.6% to $230.4 billion. Total outstanding Sukuk now surpasses $900 billion.
But, and this is a big but, the report dedicates an entire section to the significant structural vulnerabilities constraining the Sukuk market. On the supply side, issuances are often fragmented, non-fungible, and structurally complex. There's also an absence of large, regularly issued local currency sovereign benchmarks, which limits price discovery and market development.
On the demand side, the market is dominated by buy and hold strategies from domestic Islamic financial institutions. Why? Because they have limited alternative Islamic instruments and shallow secondary markets. This concentrated demand, often a scarcity premium, can distort true market pricing.
These weaknesses impair price discovery, increase transaction costs, potentially lead to mispricing of risk, constrain liquidity risk management for Islamic financial institutions, and can even amplify systemic risk.
The Islamic funds industry also saw moderate growth, but it remains structurally fragmented, with many small funds facing challenges in economies of scale and higher operational costs. So, what's the takeaway from this critical report? While the Islamic financial services industry is undoubtedly growing and expanding into new territories, its future stability and scalability heavily depend on addressing these structural vulnerabilities. The report clearly states that this requires a comprehensive and coordinated policy response. The most important factor shaping the future of Islamic finance, according to the IFSB, is addressing the weakness in the Islamic capital markets, especially the Sukuk market. This includes promoting regular local currency sovereign benchmark Sukuk to establish clear pricing, promoting simpler and standardized sukuk structures to enhance fungibility and reduce costs, strengthening regulatory, legal, and Sharia governance frameworks to build trust, developing supporting market infrastructure for efficient trading, and encouraging market making and broadening the investor base. This report is a powerful reminder. We should be incredibly proud of the Islamic financial services industry's robust growth and its expanding global footprints. But it's also a call to action. Addressing the challenges, the banking concentration, the risk of hybrid instruments, and especially the underdeveloped sukuk market is paramount. This will ensure Islamic finance truly delivers on its promise of stability, ethical intermediation, and real economic impact. Alhamdulillah, we've unpacked a lot today from the IFSB's latest report. I hope this analysis has given you a clearer picture of where Islamic finance stands and where it's headed. If you found this video insightful or valuable, please illuminate that like button with your appreciation. Help spread this understanding by sharing this content with your friends and network, especially those interested in ethical finance. And to continue your journey of grasping the ethical foundations of Islamic finance, be sure to subscribe and ring that notification bell for more deep dives into Islamic finance. I'd love to hear your thoughts and any questions you have about IFSB reports in the comments below. Don't forget to connect with me on all my social media platforms. The links are in the description. Thank you for being part of the Islamic Finance for Everyone community. May Allah grant us wisdom and guide us in all our financial dealings. Wassalamu alaikum wa rahmatullahi wa barakatuh.
If you found this explanation helpful, don't forget to like, subscribe, and share this video with your network. Let's spread the word about ethical and inclusive finance. Follow us on social media platforms for more insights into Islamic finance.